Welcome to another Fireside interview series. Today, we're talking to Simon Popple. Simon has got a storied career in the gold world. I'm very keen to understand where gold fits into the global asset allocation model, why we should invest in gold, where gold is going, etc. So there's going to be a lot of discussion about that. But before we do that, so Simon has written multiple articles for Money Week and other financial titles on gold. He's a regular YouTuber talking about gold and commodities and is featured in many articles, including in IG Index discussions. He's set up and he's the principal of Brookfield Capital and the Gold Program, which he's going to talk to us about. So Simon, first and foremost, welcome. And love to hear from you a little bit more about yourself. And then we can start delving into what gold offers us and why should investors look at gold.
Absolutely. Well, look, I mean, background is quite typical for an investor type like me, MBA, investment banking, corporate finance, and then I went into property. And it all really came out from a conversation in a pub, if I'm honest, with a mate who was talking about gold, and I kind of looked into it. And it kind of made me smile because, you talk about you don't want them to marry a gold digger. They've been as good as gold. I want to get the gold medal. Looking forward to my golden years. But then if you speak to anyone and say, do you have any gold? They're like, oh, no, I don't have any. And so I kind of found that interesting, if I'm honest. And I started looking around a lot more, doing a lot more research, and realized it was even as an asset class in itself, which we can go into later, it's very poorly covered by the investment community. And so I kind of saw a bit of an opportunity to help people who want to invest in gold and diversify their portfolio. So, I've been in it now 20, 25 years, but I started off doing more conventional buying and selling companies, buying and selling properties. And, I was the youngest director of one of the world's largest private property companies, but the lure of gold took me, and I've been ever since.
So Simon, I mean, our listeners and viewers are global asset allocators. They look at every asset class, and then you're right, when you talk to even professional investors and ask them about their gold positioning, they tend to either have a relatively small amount as a sort of outlier black swan type hedging instrument, or are not present in it at all. So I guess the first and foremost then is, why should we care about the gold market or gold as an asset?
Well, lots of reasons, but let me just talk about two. First of all, even though a lot of people say it's an inflation hedge, and in many circumstances it is, but what people need to remember is the gold price goes up and down, inflation only goes up. But if you bought a property in the US, I think 1920, it would have cost you 305 ounces of gold. And if you bought it today, the same average property in the US would cost 145 ounces of gold. So you could buy literally two properties, average properties in the US, and have gold left over if you capture gold. So it's held its value brilliantly.
I heard a wonderful thing many, many years ago, one of the family office conferences, which touches on a similar example, which is essentially that the same amount of gold bought you a high-end toga back in Roman days as it would do today for a German street top quality suit to be made for you. And again, that's example of the value of gold holding over time.
Absolutely, yeah, I know. I've heard the same fact. And the other thing is, it's a really good diversifier. A lot of people in their portfolios have probably got bonds, equities, perhaps a bit of property, but they don't have any gold. And I think it's an asset class that people should include in their portfolio. Now, I'm not a gold bug. I don't think you should have all gold, but you should have some. And I think the other point I make is kind of like, I've got my own house, okay? So I've got massive exposure to property. I've got equities, bonds, and things like that. But I see gold as a separate asset class, and I think people should have some.
And in terms of I mean, we talked about this offline a little while back around the fair price of gold, because that's the one thing I've always found very difficult to really kind of comprehend as an equities person, fundamentally, I look at, or a bonds person, you look at the value of supply demand in the marketplace. You look at, in terms of stocks and equities, you look at the valuation and decide whether it's expensive for what it's delivering or if it's good value. And then you make a decision on that. When it comes to gold, given that it's not a non-yielding asset, effectively, what's mined is not really, it's very marginal in terms of the supply demand in the marketplace, so to speak, overall, unlike, copper or any other commodity where the supply shortage will imply if demand stays where it is, prices go up. Here, that kind of supply demand is really about gold that's in the system already. So how do you see the fair price of gold? Where is the right price?
Yeah, look, that's a brilliant question. And I mean, you don't need me to tell you that valuation, you kind of like this, I don't know, 4 or 5 metrics that people tend to use. Discounted cash flow, gold doesn't produce cash, doesn't work. Price earnings ratio, gold doesn't produce earnings, doesn't work. Comparable analysis does work, but a lot of people go, look at the price today, look at the price yesterday. Wow, it's gone up, it's overvalued. I disagree with that, but anyway, that's what happens if you use comparable analysis. And then you've got residual value, which is more property, and you've got replacement cost, which is more property. So the traditional views or the traditional methods for valuing gold don't really work. And you're absolutely right. It kind of boils down to supply and demand. And I have got the 4 drivers of the gold price I refer to as MIDI, which is market uncertainty, inflation, debt, and interest rates. And I think they kind of like drive demand. And obviously the price drives supply, because if the price is higher, then producers can extract all that otherwise wouldn't be economic. But I think I found out a fact today, funnily enough, that Tether is one of the largest buyers of gold in the market, which really surprised the hell out of me. Tether I view as a crypto. And if you've got one of the largest crypto companies in the world buying gold, and not just buying gold, one of the largest buyers of gold, I find that fascinating.
So what are they using? So they're effectively using gold as the kind of backing asset, a little bit like the Bretton Woods sort of gold-backed central bank system.
The answer is I don't know. The fact they're buying gold, I just thought was incredible. I mean, I know central banks have been buying a lot of gold, but I didn't know the likes of Tether had as well.
Let's jump to that, actually, because I think it's a really interesting point. And so central banks certainly have been very active in the gold market over the last 2 to 3 years. Now, one of the reasons I've kind of played with in my own mind is that, is this a kind of a diversification without harm? And what I mean by that is that clearly international central banks and institutions own a significant amount of US Treasury. They can't really pull themselves out of the US Treasury market or stop being credited to the US without harming themselves. So one way of trying to pull away and if you like, sort of protect their own sovereignty against what they see as potentially sort of this Trumpist, isolationist positioning is to diversify towards gold and create more of a gold asset base within their own economies. And that way they buy less treasuries and buy more gold as the diversifier. And that's created, if you like, this run on gold that we've seen really in the last 18 months or so. Is that fair, or is that not happening, or is partially happening and other things are going on?
Yeah, well, I mean, central banks are clearly buying gold. And I think as much as anything, that gives a signal to the market. And obviously, you can control the value of your own currency, but you can't control the value of someone else's currency. And so I think what people like about having some gold in their portfolio is, it's fine having US treasuries or whatever the currency is, but you've got no control over that currency. Now, you're right, you've got no control over the gold price either. But if the gold price starts to come down and you can buy more of it, and it's also a diversifier. And talking about interesting facts, this week, obviously we had the budget Wednesday, I think it was, and Rachel Reeves had to fill a 40 billion hole in the economy. Now, Brown sold 5 billion of gold that is called the brown bottom at the bottom of the market. If it sold that today, I read somewhere this week it'd be worth about 45 billion. So you could have basically plugged that gap with gold, which kind of made me smile a bit. But yeah, I mean, gold is, people understand it. It's a global asset. And I think that is, in terms of, central banks and currencies, if you can say your currency is X backed by gold, people kind of understand that, and I think that's kind of important.
No, that's a fair point. And then kind of let's think about the other aspects of the demand profile for gold. So, and I kind of threw in this word the other day with you when we discussed this, the democratization, if you like, of the buying of gold. So until literally 20 years ago, 25 years ago, gold was very much in the central bank arena in terms of being able to purchase and sell, potentially some ultra high net worths, certainly large institutions could play, but people really didn't play. Today, that's not the case. Now we have derivatives such as equity traded funds in the form of GLD, which is the most liquid, I guess, ETF. There are ETFs that are backed by gold. There are ETFs that are backed by various derivatives backed by gold. There are all sorts of ways to be able to place fractionalization, so you can buy physical in a fractional format. So do you think, what's happening in that marketplace, and what are those smaller players really doing? Are they driving that gold price forward as well on top of the central bank demand?
Yeah, I mean, I'm not sure to what extent the consumer is driving the gold price, but I mean, I think that people realize that you can get gold. People said to me, "Oh, you've got to be rich to get gold." You don't. You can buy a gold coin for 200 quid, around that, probably even less. And so not only can you buy it, but you can get it stored and insured professionally. So you don't have to take delivery of it. I think that's a massive misconception. People think, "Oh, I don't want to have gold lying around the house." You don't have to do that. You can get someone to store and insure it for you. There's also a lot more product out there, as you say. You've got ETFs and things like that. And, you've not only got that, you've got funds, you've got companies. And, part of what I do is, I try to help people work out, why do they want it? What do they want it for? Do they want it for insurance? Do they want it for investment? What's their appetite for risk? How long do they want it for? And, basically, I think ETFs are very good short-term investments because, the fees are very low. If you're going to buy physical gold, it's probably more like 4% to buy. Then you've got a holding cost of 0.3, 0.5%. And then you've got, again, probably 4% to sell. So it's not a short-term investment. Insurance, I do it more as, let's say, at least a year, whereas an ETF is probably less than a year. And, you've got companies as well. Again, a company, you've got a cost of buying, you've got a cost of holding with your broker's fee, and you've got a cost of selling. I think they're more short-term than perhaps buying physical. But, I still say to people, I don't like the idea of, buying today and selling tomorrow. I think, you should have a longer term view of that. And if that's your game, then you need to be buying such a large amount that your kind of transaction costs are de minimis. So yeah, a lot depends on who you are.
No, that's a great answer. Thank you. Let's think around now the sort of the future. The gold price has run up significantly this year. We're looking at 2026 when, in my view, we've still got some of the effects of the US tariffs. And I always see the US as the sort of the global economic engine that drives everything, and everybody else just more or less follows in some form or fashion in terms of momentum. So if the US has got some lingering parts of the tariff effect still kicking through, keeping inflation relatively high versus the Fed target of 2%, I personally don't see 2% as achievable in 2026. I see the sort of the post-Jay Powell tendency of the Fed. Once that's over in May next year, we're going to have, even before then, at least a couple of Fed rate cuts. And then after that, probably still further Fed rate cuts, getting us down towards potentially even 2.5%, 3%. So we would be in almost sort of negative interest rate territory. which itself was inflationary. So I'm sort of putting words in your mouth here, but the reality is this is all really good grounds for gold, right? Wrong?
Yeah, I mean, no, I'd agree. I mean, I think the first thing that you said at the top of this conversation or this point was the US drives the gold price, to be honest. And what happens in the US, so interest rates get cut in the UK, not much happens to the gold price. Interest rates get cut in the US, a lot happens to the gold price. And going back to the MIDI I mentioned earlier, you've got a lot of market uncertainty in the US with tariffs and everything like that. Interest rates going down, good for gold. Debt going up, good for gold. Inflation, there's talk of it going down, but if you've got interest rates going down, I'd be inclined to think inflation is more likely to go up rather than down. And so the drivers are still very much there for gold. I mean, I think the direction of travel is up. What is less clear is the speed of travel. And so, there's a lot of people saying, oh, it'll go to X or Y next year. We honestly don't know where it's going to go. But I think that the direction of travel seems to be that it's going to be higher rather than lower.
No, that makes sense. And if I were to put you on the spot, which you didn't want to sort of go on to, but what do you think 2026 will deliver in terms of performance for gold? And not to put you on the spot too much, but is it a case that you think it will outperform inflation, that we won't see a sort of 3 to 5% plus, or is it another mega year, if you like, for gold?
Look, the answer is obviously you don't know, but let's just look at some facts. Since 2000, so 25 years, between 2000 and 2025, so 25 years, the gold price averaged an annual return of over 10.6% a year. Okay? Which is a lot higher than inflation. So if it continues to do what it's done over the last 25 years, you would hope it would outperform inflation again. And given what's happened to the gold price this year, those numbers I took from In Gold We Trust, who put a report out in May, and I think those numbers probably to the end of April, perhaps the end of March. But gold has been a good protector of wealth. And I think that is something that, people are looking for. And, if you don't have any, even if you only have 1% of your wealth in it, I think you should have some. And most people have got none. So I don't think they're protecting themselves or their families particularly well.
And just again, sort of on a global asset allocation basis, obviously depends on people's risk profiles, depends on people's liquidity and positioning, and how long a duration they're prepared to hold an asset. But if we kind of put that to one side and think of a global balanced portfolio, what do you think a gold allocation should be? Is it sort of that 1 to 3%? Is it the 5 to 10 or higher?
Yeah, I mean, it's very difficult to give a number because everyone is different. And if you give a number, unfortunately, the wrong person will pick up on it, and they'll invest whatever your number is. But I think you should have at least some, okay? And let common sense dictate, depending on your portfolio, your risk, and all that sort of thing, have some. And, most people have none, and you should definitely have some. So I'm skirting around your number. I'm sorry about that.
You answer in a very fair way.
But people should have some. And I think the other point is you should have gold. Now, a lot of people go, I've got a gold miner, but are they actually producing gold? And if they are, it might be that they produce some gold, but they, predominantly produce silver or uranium or something else. So, again, you need to be careful about thinking, oh, I've got gold covered, because you might not have got gold covered. And so I think you should have at least some of your portfolio in gold, either physical gold, gold funds, gold companies. And with the gold program system, I show people how to have all of that. And I think that's, in terms of all of that, just to sort of give you some number, to be well diversified, I think you need to have at least 10 grand across those kind of assets. Because if you've got less than 800 quid in an asset, the cost of buying, holding and selling doesn't really make any sense. So I think that if you've kind of got less than 10 grand to put into the sector, I'd be more inclined to get sort of low risk physical gold and perhaps, a fund or something, perhaps, or very large companies. But if you've got more like 10 grand, a bit more fun and diversify.
Simon, let's have a quick discussion about those different sub assets within gold. So tell us about where the leverage is to the gold price and where you are likely to make the most amount of money from gold like assets. So what I'm talking about is physical being the core, ETFs backed by gold, large producers, current producers. Then you've got all the bits in between to the most risk sort of profile around the explorers. And then there's the sort of group of royalty owners as well. So where should an investor sort of position themselves across those sort of subsectors of gold, if you like?
Well, I use the fantasy football format, which I think people kind of get, because what I say is, you need a stadium, physical gold, training ground, which is a fund. And then you've got a goalkeeper, which is a large multinational. And then you've got defenders. Now, depending on how many, your appetite for risk, you either have lots of defenders or not that many, but you've got to have some. Then you've got midfielders, which are kind of companies that are either new to production or, let's say, more reliant on one particular asset, so they're higher risk. And then you've got your forwards, which are your out and out explorers. Now, in terms of what people want, I would say build from the back. So there's no point having loads of forwards if you don't have any physical gold. So I would say get your physical, get your fund, then get a goalkeeper, defenders, and then move up the risk curve to get your forwards. The forwards can produce life-changing returns. I invested in one and I made, like 40, 50 times my money. I could have made more like 65 times. I know there's junior miners out there where you could have made 100 times your money. What I teach people is, if you're going to go into those types of companies, you probably want to make sure that one's already got a resource. Now, when they've made a big discovery, the share price will probably go up 3 or 4 times. But if they've made a big discovery, then you're kind of hoping that they've got more gold in the vicinity. And therefore, it's a slightly less risky investment because they've already found some. And I think similarly, let's say they do run out of money, because they can already prove that they've got some, then there is some value to that company. So in terms of your investment, it's unlikely to go to zero. On the contrary, you could invest in a company that's not made any discovery. If it finds something, your shares go through the roof. But as they haven't made a discovery, what they could do is they could blow all the money, not be able to get any more, and then you've got a company that is probably worth nothing. So, you need to be careful.
We've got some 4 or 5 minutes left. And what I'd love to know is, as a derivative around gold investment, should we not even look at gold and go and buy silver instead, which has a significantly higher leverage in terms of both upside and downside versus gold, and is an industrial metal as well. So at least we actually have some legitimate demand supply statistics here.
I think it's both, if I'm honest. They both have leverage, but the leverage is slightly different. The leverage for a gold and silver company is you've got a gold and silver company and the debt goes into the company. So the company is taking the risk, not you personally. A lot of people are kind of used to leverage, let's say with a property where your name is on the mortgage agreement. So you personally are taking the risk. With a company, it's different. But silver, I like silver a lot. I like gold, I like silver. There's lots of other things I like as well. But, there's talk about going into a commodities super cycle. I don't know how long that'll last. But if it does, if it lasts for several years, which, obviously you'd hope it would, there could be a huge amount of money to be made. And I know there's people out there who miss the property boat. And this is probably not a boat you want to miss.
Fair enough. Simon, what are you doing at Brookfield Capital? What do you want to tell us about the gold program? I'd love to hear from you and how we connect with you.
What I do is I've written a book, which is The Beginner's Guide to Investing in Gold, which is kind of your starting point. If you want to invest in a system which has taken me years to put together, it's very simple, but you can get that £99 and you can put a system together of investing in gold. If you want to go beyond that, I've got a course, and beyond that, I've got the gold program where I have a call with you, and we have a sort of in-depth discussion about what you want to do. So what I do really is teach people how to invest in the sector. And a lot of people, as I say, they've got a bit of gold, they've done this and that, but they don't have any strategy. And I'm really all about strategy, helping you have a strategy to invest in the sector. So if you want to find out more, you go to www.goldprogram.co.uk, and you can find out all about not just what I've just mentioned, but gold itself. And there's a lot of blogs on there, which hopefully you'll find interesting.
Fantastic. Simon, thank you very much. It sounds to me that 2026 is going to be a year when gold still remains very much a feature of a global portfolio in an environment of inflation that is not going away, that's probably going to remain relatively sticky, in an environment where the Fed is probably going to take a very dovish role. Gold will play a significant factor here. Maybe the last word to you, Simon, and then we'll head off.
Yeah, I mean, look, I totally agree with you. I put all my daughter's money in gold and silver and platinum. She's done ridiculously well. I think gold could have some great days ahead, and I'm yet to sort of hear of any reasons why the gold price could come down. So will it move around? Yes, it will, but I think it could be a great asset to have.
Wonderful. Simon, thank you very much for your time, and have a golden Christmas.